Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome, ladies and gents, to the Absolute Return Podcast. I'm your host, Julian Klimachko, and I'm joined by my co-host, Mike Kesslering. On today's podcast, we welcome special guests, Scott McNeill and Jim Mutrie, co-CEOs of Switchback II. The company recently announced a $2.3 billion business combination with Bird, a leader in shared, short-range, environmentally friendly electric transportation. On the show, Scott and Jim discuss their background in oil and gas and subsequent pivot to an energy transition focus, the thesis behind Switchback's series of SPACs and lessons learned from the ChargePoint deal, why Bird was an ideal merger candidate for Switchback II, what differentiates Bird in the highly competitive micromobility sector, and more. So with no further ado, here's our discussion with Scott and Jim of Switchback II. All right, excited to have Scott and Jim from Switchback II and the other Switchback series of SPACs. As many listeners may know, they're the team behind the highly successful ChargePoint deal of last week, one of the big winners in the SPAC space, and they're out with a second one, merging with Bird, the micromobility scooter company that I'm sure most of us know. I tend to see a number of the Bird scooters on my daily walk into the office, and they do have a third SPAC filed but not launched yet, so we won't touch on that one. But prior to getting into the deals that you guys have done and what you're working on, Jim and Scott, if you don't mind telling our listeners a bit about your backgrounds. I noticed going through your biographies, spent a lot of time in the traditional conventional energy industries, specifically oil and gas. Now you've made a bit of a pivot to energy transition, which we're seeing a lot on the private equity side, investing side, as you see this big macro shift into ESG, sustainability, more environmentally friendly modes of energy production and mobility. So would you mind walking our listeners through your career history and your background, expertise, et cetera?
Yeah, sure. Why don't I jump in first, and then Scott, if it's all right, you can jump on or correct me on anything I misstate about our kind of collective background as well. But this is Jim and Julian. Mike, thanks very much for having us. We're excited to be with you guys today. So just quickly on my background, how I got into the energy transition business, just by way of stepping back all the way to the beginning. I'm actually from the Northeast originally, went to school in upstate New York at Cornell, met a girl from Texas and followed her down to Dallas in 1997. Wanted to get into the business world, but I took a somewhat unconventional route, went to law school, worked in public company mergers and acquisitions and securities for a few years, and then went to become the general counsel and business development lead at a public company. 2014, I had the opportunity to partner with Scott, who I had known since, I think, back to 2000 or 2001. And we partnered together at RSP Permian, which was a company that we were in the process of taking public and growing it from approximately a $1.2 billion market cap to about $10 billion in 2018 when we sold that public company to another existing public company. After that, we wanted to partner together again. We took a little bit of time off, and then we partnered in the first Switchback iteration, which we took public, I believe, in the summer of 2019, in July of 2019. And then, as you mentioned, we've done a second and have filed a third Switchback after that. I can tell you a little bit about how we made the pivot that you mentioned from kind of traditional oil and gas, which was the focus of RSP Permian, into energy transition. And then I'll let Scott chime in and obviously let him give you his background as well. But RSP began with a thesis about disruptive technology. And I think that tenet, that core, has kind of flowed through all of the switchbacks in the energy transition space that we're in now. Now, back at the time of RSP, that disruptive technology was horizontal drilling, and you could apply that technology to allow us to decrease our reliance on foreign energy, kind of traditional energy providers. But by the time Scott and I were in the process of selling RSP in 2018, and frankly, probably even before that, 16, 17, as we met with investors and started to see the ground shift in that popular sentiment change, as we talked about that macro shift in the ESG sustainability. Certainly by 2018, I think we had recognized that energy consumption had really reached a tipping point. And I think what drove that more than anything are some technological advances in wind, solar, battery storage, things like that made alternative energy more economic than it had been previously. Previously back 2014 when we founded RSP, the economics were far more favorable for traditional energy consumption than they are for alternative energy. I think that playing field is much more even these days. And then the second big point was, as you said, that popular sentiment shift by 2018, 2019, when we raised our first SPAC, that shift toward ESG and sustainability, environmentally friendly energy, we had recognized that shift was well underway. So our decision with Switchback to partner with a private equity firm, NGP, who had been investing in this alternative energy space for 15 years, was pretty purposeful. So I covered a lot of ground there. I want to give Scott, obviously, the opportunity to give you his background and chime in, but that was kind of I think the logic for us on the shift as well as our involvement in energy consumption back to the earlier days of our careers.
Thanks, Jim. That was a great intro. And as Jim said, we've known each other for a while. In fact, I think the very first IPO Jim worked on as a baby lawyer, I was the equivalent on the banking side. And I spent 15 years as an investment banker in the energy sector, really covering a wide spectrum of companies in the energy value chain and transactions, but always primarily working with high growth companies on IPOs, attracting growth capital, working and advising on M&A engagements, and really identifying and helping companies that were ready for the public markets. And along the way, I had the opportunity to work alongside NGP, who is our current private equity sponsor, as Jim said. I got a call from the managing partner there, who I'd known for some time, actually had been on a road show with the managing partner, helping them raise some capital. And he said he had a startup company that they had backed and that they wanted to put me on the board of the company and on the management team to help grow that company and really position it for an attractive exit. Not really knowing it would be an IPO, but we grew that company from a private startup as actually the 20th employee. As Jim said, we built that company up to $1.2 billion. I think it's about $1.5 billion enterprise value at the time of the IPO. And we were the management team that ran that public company. And then we ended up selling it for $9.5 billion. So Jim and myself, we felt like we had the perfect skill set for running a SPAC, because not only did we have the deal experience, both from an investment banking and from a legal background perspective, but we also had experience of taking a private company and getting all the systems in place, getting all the right people in place, and being able to take it public and have the relationships existing with public company investors, and being able to raise another public vehicle in a SPAC, and having all that expertise and that experience, and really having that reputation. Because what Jim did share with you is that, in our industry space, we had not only a great track record, but one of the best track records of any public company in the sector from really start to finish. So that helped us. And then I think one thing I just add on to that, Jim talked about in terms of the underlying dynamics and the shift going on inside energy is that, we realized that traditional energy is really more in a harvest mode and kind of a return of capital phase. And energy transition is still in this huge growth phase. So we felt like that with a SPAC, what you're really doing is providing growth capital, and the best sort of long-term growth potential we felt like was in these energy transition names. And then the other thing is that NGP, our sponsor here, and was our sponsor of private companies, they're not only have they been investing in the traditional energy space, but for the last decade and a half, they've also been investing in this energy transition phase. So I think together we just felt like we had a real powerful network and a real powerful set of skills to be able to find the right companies in this energy transition space.
Now, I wanted to get into the overarching thesis behind the Switchback series of SPACs. The first one, of course, did the ChargePoint merger. The second one announced a deal with Bird, not closed yet. You have a third one on file. Is there a playbook you guys follow? You mentioned a number of key themes, which is energy transition, sustainability, and growth. What's the same between these, and what's the overarching thesis behind the SPACs? What are you guys trying to accomplish?
Yeah, you set me up. You set me up very well with that question to how we thought about approaching ChargePoint, and then taking that similar playbook and applying it to the Bird transaction. We really refined our investment criteria when we went into the Switchback I transaction, because we knew that there was going to be multiple opportunities out there, multiple targets. The problem isn't finding a deal; it's finding a good deal, finding the right deal, a deal our investors are going to benefit from in the near term as well as the long term. And for us, we laid out and very purposefully addressed kind of an investment criteria of 6 key points that applied both to ChargePoint and then the same thing to Bird. And we think they check the boxes for both of those transitions. The first point was a disruptive technology with a large addressable market. And for ChargePoint, being in electric vehicles, that disruptive technology and the large TAM. Obviously, Bird micromobility, which has $800 billion of opportunity in electrified micromobility, and something we didn't realize, or I didn't realize until we got smart on the space, of how many trips are less than 5 miles, 60% of all trips. The second point was the management team had to be a public company ready, experienced management team. We saw that with Pat Romano at ChargePoint, and certainly see that with Travis in Yibo at Bird. Travis created the micromobility space, the originator of it, and he focused in on the unit economics that I'll talk about in a minute, before really anybody else in the space did. Everybody else in the micromobility space had been focused on growth, and Travis honed in on growth, but also with compelling unit economics. So that management team and a public company ready management team was a key second point. Third point, market leadership. ChargePoint was the largest EV charging company in the world. When we partnered with them, similarly, Bird is a market leader. They had raised $1.1 billion to date, prior to our deal being announced. And as you said, we haven't closed the deal yet, but it just puts a lot of space between, our partner and the rest of the market. The fourth point was a business model, compelling business model. ChargePoint had an asset-light business model, or has an asset-light business model that differentiates them, and Bird has this fleet manager model, which we can tell you more about, but it partners with individual entrepreneurs and really reduces Bird's capital, the cost of capital that would sit on their books. It's a compelling, novel business model that Bird has introduced. The last 2 points, and these are 2 of the most critical, is a returns-oriented company. There's a lot of companies out there, especially in the energy transition space, that their revenue is years in the future. If everything happens a certain way, they have a compelling growth profile. While that may work out for some companies, as Scott and I like to say, we don't like to fund science projects. We want to partner with somebody who's actually already proven that they can do this. So Bird, for example, had $150 million of revenue in their second year of existence. They're going to have over $400 million of revenue next year. So it's not just an idea; it's an actual company, and I think that's incredibly important, particularly these days in the SPAC market, to partner with a company with a strong cash flow position and an actual business, not just a good idea. And then the last point for both transactions was ChargePoint, or is Bird at an inflection point? Are they ready to be a public company? We thought the way the electric vehicle space was happening was shifting and moving, and adoption rates, that a public charging company was just, was the perfect time when we took out ChargePoint. Similarly for Bird, we think the micromobility space is at an inflection point as well. There's some tailwinds coming out of COVID. favorable regulatory changes and industry consolidation. And as I also mentioned earlier, and a management team that's ready now to take the next step with Bird to be a public company. So that kind of that investment criteria that we laid out in advance of the ChargePoint deal, that it checked all the boxes for ChargePoint, we feel just as strongly about the Bird transaction that it checks all the boxes as well.
So there are these constant investment criteria that you guys are sticking with throughout your various SPAC transactions, and obviously with the ChargePoint deal, starting things off on the right foot. I was wondering, did you glean any key insights from your ChargePoint deal when approaching your second SPAC?
Yeah, hey, this is Scott. I think Jim covered a lot of that in those key criteria points. I think the insights all hold into the second deal. I think what we take away from the ChargePoint, transaction, other ones that have traded well, is that, the market is going to reward you if you back the right company and the right management team. We feel like there's too many companies that are really just too early. And as Jim was saying, don't have a proven business model yet, and or they've got products that have yet to be developed. And so there's a, kind of a theoretical sort of revenue model out in the future or service that's yet to be built. And so, I think going back to his comment that we don't fund science projects, I think finding the right company that's truly ready to be in the public market, and there's one more round of capital where they're in the inflection point, I think that's really the key ingredient. And then I think another thing that he didn't touch on is that just, I think in this environment that you want to partner with an experienced SPAC team, somebody that, has already been through a successful transaction like what we did in ChargePoint, because we just have the expertise and the experience, and we've been through it from the very start to the finish. Know the public markets, and having a reputation is important, but really understanding the SPAC process and the structure and all those things combined will ensure that a deal that can get done the right way. And there's a lot of, I think, SPAC sponsor teams that are out there for the first time, and we've gotten into a market that's been very choppy, and I think it's very difficult if you haven't been through it already. So I would add those two things and hand it back over to Jim. He may have a couple other key insights.
Yeah, Scott answered it very well. I wouldn't add anything else of substance on top of that.
And now a word from our sponsor, Accelerate, one of Canada's most innovative and fastest growing alternative investment solution providers. With a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate One Choice Alternative Portfolio ETF, symbol 1C, ONEC on the TSX, is Canada's first alternatives portfolio solution, providing exposure to 6 alternative asset classes, 10 alternative strategies in one easy-to-use, one choice ETF that charges a management fee of just 0.2%. The Accelerate One Choice Alternative Portfolio ETF trades under the symbol 1C, ONEC on the Toronto Stock Exchange. Find out more at accelerateshares.com.
Something that you mentioned earlier was that what you're looking for is returns-oriented companies. And I find that interesting in the context of ESG. I think a lot of the perspective of an outsider's perspective of the ESG is that it's mission-oriented companies as opposed to returns-oriented companies. Do you think that those different ways of viewing companies are kind of in conflict, or do you think there is truly a lot of niche for returns-oriented companies within the ESG space?
Yeah, I don't, and let Scott add on to this. I don't think they're in conflict at all. I think one of the things I had mentioned earlier on, and one of the thoughts that Scott had as we transition from traditional energy consumption to alternative energy, is I think that the technological advances in the last 5 or 6 years have made those two ideas a compelling investment, as well as ESG friendly goals, much more compatible, than they've ever been before. The economics may not have made sense if you look back historically or 10 years ago, but you see this just rapid change in technology, and as I mentioned, solar, wind, batteries in general, or energy storage, that enable this energy transition to be both economic as well as to continue to maintain its ESG friendly goals. So no, I at this day and age, I don't see them as incompatible at all. Now, again, it's not, as Scott highlighted, not every company is in the ESG space is at that point. You know, our key point is figuring out which ones check both of those boxes, ESG friendly company with that mission and rooted in those values, but also offers compelling returns to investors. And we think we did it in ChargePoint, and we feel confident we're doing it again in Bird, that you can have the best of both worlds these days, which may be a little bit different than what would have been 10 years ago or even 5 years ago.
Now, I did want to get into the Bird transaction, $2.3 billion enterprise value, $160 million pipe being led by Fidelity. I was wondering, with respect to the investment criteria that you mentioned, disruptive technology, large TAM, unit economics, market leader, returns-oriented management, what specifically made Bird the ideal merger partner for Switchback II?
Why Bird was the ideal partner, as you mentioned, on those in our investment criteria that we checked. You know, we found, again, I think foremost is, can you find partners who are compatible, share the same vision both for the company as well as a relationship with investors going forward. We found that with Travis and Evo in the Bird team, that results oriented company with massive revenue after just a relatively short history. They're again after 5 years, they're going to have over $400 million of revenue. When you stack that up against other public companies that are been extremely successful, Google, DoorDash, Uber, Tesla, it's tracking well above those areas. You know, those things really jumped out to us that, you know, this may not be fully appreciated by the market of, you know, what a growth opportunity it is, but also what a track record for a relatively young company that it had established itself. And I think also in addition to that, you know, Bird continues to innovate going forward, and whether it was their technology, their hardware with the Bird 3, and we can talk about that if you'd like in a little bit. They're constantly innovating, and every innovation, like as I was kind of mentioning earlier, in energy transition in general, with each of these iterations in technological advances, the unit economics get more compelling, and we see them driving, you know, better and better unit economics in the immediate future, and, you know, the growth in that kind of unit economic growth has just been quite large over the last several years, and we see it happening in the near future as well. And I guess the last thing I'd say, I also like the timing of the transaction. I think Bird, with the capital it had raised to date, the position it had taken in the market, had established itself as a market leader, and I saw it as somewhat of a reopening play as well. That there'd been some favorable regulatory changes to allow this kind of socially distanced mode of transportation as you move into a reopening phase in the U.S. and the world. People wanting to get out, wanting to see their city, commute to work again. That Bird was really positioned to kind of ride that upside from a reopening play as well. So we thought the timing was right, both from taking the company public, but also other factors playing into how the macro economy and coming out of COVID set the company up.
Yeah, that makes sense from a recovery play standpoint. Now, this transaction also comes with a concurrent $160 million pipe, plus you're bringing some cash from the SPAC as well. What are the use of proceeds, and are you funding growth? What are some of the major initiatives?
Yeah, this is Scott. I'll jump in on that question. Is that the company? You know, they already had a couple $100 million on the balance sheet. They're going to bring in $160 million in the pipe, and then the trust as well. So they're going to be, you know, very well capitalized as a company coming into the public markets. And the use of proceeds, first and foremost, is just to further penetrate some of the existing regions that they're in. So they're going to be expanding in existing cities, plus, adding some new cities as well. They're going to be expanding to some new regions. So we'll see the Bird brand going into areas that they're not currently located in some different regional coverage. And then And then finally, continued innovation. And, we already saw the launch of the Bird bike, which is a new form factor. And so there'll be some additional innovations that happen along the way. So they're just going to be continuing on this growth phase and using this capital to really expand their growth and their profitability.
So there's a few other big names in the micromobility space. Do you see this as a winner-take-all market that Bird is going to be able to be the most successful player in, or how is it going to be successful?
And now, a word from our sponsor, Accelerate, one of Canada's most innovative and fastest-growing alternative investment solution providers, with a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate Arbitrage Fund, symbol ARB on the TSX, is the world's first SPAC-focused ETF with a diversified portfolio of SPAC and merger arbitrage opportunities in an easy-to-use, low-cost ETF. The Accelerate Arbitrage Fund ETF trades under the symbol ARB on the Toronto Stock Exchange. Find out more at accelerateshares.com.
Yeah, so it's a great question, and I think we heard, obviously, a lot of people talk about, the competitive framework that, Bird is in, and I think there's definitely room for, more than one player, and actually what you're seeing happen is that there is not only a competitive advantage just from the standpoint that Bird was out there, first in this micromobility space, but there's several barriers of entry that is in this sort of micromobility ecosystem that we're seeing. And I think getting out to a first mover advantage and being the creator is, creates the ability for them to have a tremendous learning curve of knowing, how to run the business, but also just the experience and the institutional knowledge that they're bringing in, and also just the scale. I think being a leading player in their main markets, creates this economies of scale, both, on a global basis as well as down on a local basis. But I think what's really interesting when you're talking about winner take all is from just a regulatory framework perspective, and that, Bird not only has significant experience, collaborating with these municipalities and regulators. They've got the highest permit win rate in the industry. And what you're seeing is that within these different cities, they're not just opening it up to anybody to come in and have e-scooters or e-bikes. They're really limiting it to 2, maybe 3. And so you have to proactively develop the partnership with the cities. And, there is this opening sort of regulatory environment for micromobility and for e-bikes and e-scooters that's going on right now. And I think being a major player has a significant advantage. And then I think one of the interesting aspects is just the fleet manager model and the business model that Bird has adopted. They've really lowered their fixed cost base, and by relying on these fleet managers to provide the infrastructure, the garages, and then taking care of the vehicles, it really enables, Bird to move into these smaller markets and these long-tail cities. And they've built this strong base of fleet managers. And, of course, they're providing, all the support and the tools along that line to make that fleet manager model really profitable and expands the opportunity set for them. And then I think also on the technology side, when you take a look at a Bird scooter or now the e-bike, you can see they're just well ahead of the peers. You can just take a look at the half-life of these vehicles, and you can see that not only have they advanced the technology, but the safety is better. They've got better battery life. It's just a more robust product offering than what the competitors have, and they've also, lowered the ability for anybody to steal the scooters. You can't really take them anymore. I think early on they had a pretty high loss rate associated with theft, so you don't see that. So that all, points back to what Jim was saying on, really focusing on the economics of the business. So they're just very, they're ahead of the game. They've created just a world-class organization, and they've got the scale and the ability to continue to grow and to really lead this whole sector. And so we're excited to partner with them.
Now, before wrapping things up today, Jim and Scott, I wanted to give you the chance to just state the case for the stock for investors. There's a lot of SPACs out there, and there's a lot of disruptive technology companies, and you're seeing more and more competition in the mobility space. Why should investors pay attention to Switchback II and Bird?
Sure. I think we'll tag team this one. Why don't I start? I think overall, we feel very good about where the company's positioned right now. We think the market is moving toward us, frankly. The model, first of all, I think the model works from a unit economic standpoint, and that's something its competitors and a lot of companies in the energy transition space can't say that. The revenue profile that we talked about earlier with $400 million of revenue next year, $150 million of revenue in its second year, or if you compare it to some other of companies in the disruptive technology space like Google, DoorDash, Uber, Tesla, the revenue profile of Bird being nearly 2x any of those, in some cases more than that after 4 to 5 years of existence, shows that they're doing something right, and that they have the unit economics figured out, and that they're honed in on those unit economics. So that, that also then ties into, if you look at our valuation, we think it's quite conservative, and it really is a compelling valuation and offers a lot of upside for the stock. Like the second thing, and we had mentioned it earlier, is the tailwinds coming out of COVID. During COVID, there has been some consolidation in the industry, and I think coming out of COVID, then this socially distanced way of transportation, as opposed to piling back onto subways or buses, that's appealing. There's a reopening element to that as people want to get out and around. They're more and more doing this on e-bikes and e-scooters, so playing right into Bird's business there. Scott had mentioned the favorable regulatory changes where cities are becoming more amenable to e-bikes and e-scooters. If you look at New York City, for example, where Bird won the permit in New York City, they've introduced now additional bike lanes and e-scooter lanes. So cities are just more open to, hey, let's lower the carbon footprint. Let's lower the idea of cars, single passenger cars congesting the city, and offer environmentally friendly ways to transport around the city, frankly, in a more efficient manner. And then I think maybe the third thing about the stock is that there are a number of catalysts coming up. Scott mentioned that the e-bike and the third generation e-scooter being introduced now. So catalysts there, the city adoption. It's kind of funny. When we started talking to Bird, and actually when we were in the PIPE process and we announced the transaction, Bird was in slightly under, just right around 200 cities. And as we're talking today, they're in over 250 cities. So the adoption rate for Bird is very high right now. They just have a close connection to a lot of municipalities, and a really refined approach to introducing themselves to municipalities and working hand in hand with those cities. As I mentioned before, being a catalyst, the record summer travel and people coming out, just a real reopening play as well. And then the last thing, which again I maybe could lump under the catalyst banner, would be just it being the first public micromobility player of scale. Really gives them an advantage position go forward to take a lion's share of this market. Doesn't mean it has to be a winner take all, but it puts them in a great position.
Yeah, I couldn't really add very much onto that. I think he covered all the points. I think that if you take a look at the first quarter numbers that they put out and filed, you can see that there's some strong momentum that's already coming into the summer. I think what we're seeing and what we're all witnessing is that people are ready to get outdoors. They're rediscovering their cities. I think that getting on an e-scooter and an e-bike is a really good way to do that. And so I think that just what all the things that Jim said about, getting the increased penetration inside of in each of these cities and into new cities is going to be a really nice catalyst as we, come out of the de-SPAC process and they charge ahead as a public company. I think you're going to see that momentum continuing because, again, even though they've got a substantial revenue base underneath them, it's still really early in the evolution of their business plan. So it's a nice time to take a look at the stock and take a look at the addressable market and all the strong points that Bird has and will have as a public company.
And Switchback II, trading under the ticker symbol SWBK. Bird deal expected to close in the third quarter, I believe, and then up and trading as a newly minted public company. So exciting stuff. Thanks, gents, for coming on the show today, explaining the thesis behind Switchback and some of the key insights and details behind the Bird merger. So we wish you the best of luck, and we'll be monitoring your progress as you guys complete this Bird merger.
Thank you very much, Julie and Mike. We really enjoyed it.
All right. Thanks so much, guys. Bye, everybody.
Okay. Bye-bye.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.